whatever category you fall in, you're going to get a lot of good information in this workshop tonight. Now, as Sam mentioned before, there's probably 5 or 6 hours of material we're trying to cram here in 1 hour. So we're not going to be able to cover everything in complete detail. So we've drafted a workshop companion guide that goes into more details. And we're going to email that out to you after the workshop, and you'll want to check that out. Now, also, I should mention, if you want to, during the workshop, you can actually set up your SmartTrack account. I think, Sam, you've already posted the links in there for the families to do that, right? And so you can find that in the chat box. Just make sure when you do that registration, use the same email address you used for this workshop, and only set up one account per household. Don't try to create student and multiple parent accounts. Just one account per household. If you don't have to do it right now if you can't get to the chat, but if you have time, that you can take advantage of that.
So there are 3 types of people who attend our workshops. We have the do-it-yourselfers. So we welcome you to learn as much as you can about the ins and outs of this process. And there's going to be a lot of very valuable tips and how to improve your outcomes and save yourself money. Sometimes I'm a do-it-yourselfer. And then there's the ones that are resigned to paying full price. Like there's folks that think there's little or nothing that can be done for them to improve how much they'll end up paying for college. And that's what colleges want you to believe. And, hoping for the best is not a plan. So most of our clients are clients that have saved money that never thought in a million years they could save money on paying for college. They just resigned to paying full price, or that's what it is, right? But we're going to show you otherwise. And then there are those parents that have, lots of questions. Maybe they're confused about the process, overwhelmed. This is very natural. It's a very, very stressful process. And so if you have those questions, you're going to get a lot of answers today, and we'll show you how to get all of your questions answered as well. So we want all of you to get the most out of this workshop.
All right, so let's real quickly just kind of outline some of the issues parents are going to have with paying for college. Number one, it's expensive. Depending on the school, the list price is going to be $25,000 to $100,000 a year. There's a lot of variables. Kids will be looking at multiple colleges. You don't know what the cost is for the one they're eventually going to go to. You don't know exactly how much scholarships, grants, and aid they might be receiving. Some colleges it's hard to finish in 4 years. So now if you have the 5th year, there's just a lot of variables. And then there's huge opportunities costs. College doesn't happen in a vacuum. Any money you save or spend there is going to have a direct impact on retirement and other financial issues. And the biggest cost to college is not the money you spend, it's what that money could have grown to and been used in other things if you hadn't spent it. Because the formulas are very nuanced, small mistakes, things you would never even think of can end up costing big chunks of money. And again, there's uncertainty in the whole process. And it's a very confusing process. There's a lot of inaccurate information out there, whether you're looking on the internet or getting, listening to your neighbor who's supposedly an expert on it, or even a lot of financial professionals and CPAs. There's just a lot of misinformation, and there's limited guidance. It's a pretty small niche industry. It's not like there's, 3 million college planners out there like there are CPAs or financial planners. So finding the right source of help can be hard. But no matter what your concerns are, success in the college funding process has 2 steps.
Yeah, the first is you need to get educated, informed about the college funding process, the formulas, the back end, what happens behind the curtain, and how that applies to you. See, these are some of the things that you're going to talk about today. It's not about how to make it. It's not about saving money necessarily, or how to make it easier or less expensive. It's about how to make it more affordable, how to save either money on how you pay for college or what you pay for college, or both. And we're going to talk to you about a lot of different things that attach themselves to that, including your tax return. So we'll go into a lot of detail about how families are assessed, and how they can save significantly off the cost of college, like we talked about. And the second real step is to get a professional evaluation to find out which information that we learn here applies to you and how. And the best part is that's free. So this valuable information is offered usually for a fee. We work with hundreds of private high schools and schools and boarding schools, even where families are paying 20, 50, even $100,000 in pre-college education, and they pay for this. But through NCSA, you're getting that level of service at a very, very affordable cost. So let's sit tight and I'll show you how to access that in a little bit.
All right, so let's take a look at some examples of some colleges, what's called cost of attendance or COA. And, these numbers are way higher than I went to school, I know that. But, whether you're looking at a public or a private institution, in-state, out-of-state, that full cost of attendance for a four-year degree, and that cost of attendance includes tuition, room and board, an allowance for books, and then usually about $3,000 of what are called personal and transportation expenses for the student added in. So, that range for 4 years could be as low as 100,000 or as high as 400,000 per child, which is a very huge commitment, obviously. So even though colleges are very expensive, the good news is there are ways to reduce those costs. So let's start talking about the different types of grants, scholarships, and aid that's available. Now, the first and the largest pool is going to be need-based aid. And this is awarded based on the parents' and students' income, assets, and other factors. There's other factors, but income and assets are going to be the primary drivers. Now, we're going to spend a lot of time talking about need-based aid throughout the workshop, so I'm not going to spend too much time on it right at this minute. Now, the second source would be merit aid, academic merit scholarships. And this is available at most colleges. Now, the biggest exception is going to be your Ivy League and Ivy League equivalent schools, which are now considered 100% need schools because 100% of the need, 100% of the free money they give away is based on need. And using the national formulas, they will always meet 100% of your demonstrated need. However, most colleges still provide academic merit aid, and they're using it as a tool to entice students that are high achieving students, that students are going to be at the top of the academic profile compared to the rest of their normal applicants. And keep in mind, the top of the list varies dramatically from school to school, so you don't need to be a perfect student to find merit aid. And although merit aid is primarily based on the student's resume, in some cases, it can also be impacted by how the parents' financials are organized. And there's some more information about that in the workshop companion guide. Then we've got the athletic scholarships. Now full ride scholarships, athletic scholarships are fairly rare. Most sports, you're going to be getting partial scholarships. The exceptions that would be, the big money Division I sports, football, basketball. And then also remember, Division III cannot give any athletic scholarships. However, having a coach that really wants your student on their team can enhance both the admissions and other scholarship possibilities. And this is why the academics are extremely important, even for student athletes. And then the last one is private scholarships. And by private scholarships, we're talking, these aren't directly from the colleges. They're coming from, large corporations, nonprofit groups. They tend to get a lot of publicity, but in the end, they make up less than 4% of the total scholarship funds that are available each year. They can be very time consuming to pursue and provide no guaranteed results. And in some cases, the scholarships may actually get offset against and reduce the aid that the college would have given you. So this is an area where you really want to manage the expectations on this one. All right, so going through the whole financial aid process can involve a lot of different deadlines, forms, requirements, and some of that's going to depend on what colleges you're applying, some of the particulars of the details of your family situation. But the two most basic starting points are going to be the FAFSA and the CSS profile form. So let's take a look at those. So the FAFSA, this is a federal government form that is used by college's financial aid office to award aid from the federal government, the state government, if there is a state program. Some states have programs, some don't, as well as money that's going to come directly from that college's budgets. Now, again, there's a lot of details on the FAFSA in the workshop companion guide. We just don't have time to go through all of the details here tonight. But one really important thing that you need to understand is the timing of the information that the FAFSA uses. So for income, they use what's called a prior tax year. So for a student graduating in 2028, they would be looking at income from 2026. This is when your child's still in the 10th grade. However, and this is really important, for our junior families, the assessment of your assets is based on what you have on the day you file the FAFSA, which is typically in the fall of that senior year of high school. So if you have a junior now, it is what we call, 911 time. Don't wait any further in the fall to get started. It's coming up really fast. You're going to want to get started right now. But due to the way this timing works, some strategies involving income work best if implemented before that prior year. However, there are other strategies involving assets that work right up until the time you file the FAFSA. So the takeaway is start planning early if possible, but know that you haven't missed all opportunities if your student's already a junior.
So there's a lot of confusion out there, and we're financial guys that specialize in this, the whole team there are. So we want to kind of clear the air. So what assets count on the FAFSA? All of your bank accounts, investment accounts, 529s, most trust accounts, student accounts, investment property, and child support. We're going to go, like I said, in a lot more detail in a little bit. But basically, any kind of non-retirement asset. What's exempted are your personal assets like jewelry or car, primary residence, qualified, non-qualified retirement accounts, small business valuation. What income accounts on the FAFSA? Your W-2 income, some retirement contributions like SEP and IRA. So those monies that you put aside in those will be counted. Business real estate net income, interest, dividends, capital gains, or passive incomes, retirement distributions, royalties, taxable Social Security, unemployment benefits. What's exempted as far as income are some qualified retirement contributions into a 401k or 403b, HSA contributions, spousal support gifts, and some workers' compensation or disability payments.
All right, so the CSS profile is a much more in-depth financial application required in addition to the FAFSA by some of the private colleges. Now, depending on the schools you're applying to and the particulars of your situation, there can literally be hundreds of questions on the CSS profile. They ask way more information than the FAFSA does. They're going to ask about your income and assets. They're even going to ask about your retirement accounts, your businesses, your home equity, plus a lot more. And a lot of the information that they ask for isn't even used directly in the financial aid formulas. But colleges will use the information from this CSS profile to calculate their institutional aid. So the colleges that take the profile are still going to award federal and state money from the FAFSA. They're only using the profile for their money. And this form, like I said, is very in-depth. It is complicated. Many of them are submitted with errors. However, it is a very important form. There can be a ton of money riding on this form. So when it comes time to do that profile, make sure you set aside ample time, do some research ahead of time. Don't just rush through it. Make sure you give it your best effort. Sam likes to joke sometimes, when it's time to file the FAFSA, grab a glass of wine. When it's time to file the profile, get at least a bottle and maybe even a whole case of wine.
So what assets count on the CSS profile? This is where people get it wrong on both the FAFSA and CSS, especially financial people. So everything that is assessed by the FAFSA plus parent 529s for all the children. If you have 3 kids with 529s for each, the CSS will group it as a parent asset. On the FAFSA, it's only the student in question. Your primary residence has a section, small business valuation, income that's assessed, everything that is assessed by the FAFSA plus W-2 qualified retirement contributions. So if you're contributing to a 401k, 403b, 457, they're going to add that back in. Non-taxable workers' compensation and disability.
Okay, so the colleges, are going to use the FAFSA and the CSS profile to determine whether a family is going to receive financial aid or not. The information on the FAFSA is used to calculate what's called a Student Aid Index, or SAI. The information on the profile is used to calculate your expected family contribution, or EFC. Now, we're just going to use the acronyms for the rest of the workshop for time's sake. So that SAI or EFC number reflects how much the colleges think you can afford to pay out of pocket per year per student. And unfortunately, many parents are kind of shocked and dismayed by how high those numbers can come out sometime. But one thing to remember is, there are many things that can drive up that SAI and EFC other than just your, salaries and wages. It could be, different forms of passive income, assets, businesses, real estate. So because of this, it means there's also many ways to lower that SAI or EFC with proper planning. So the formula is the cost of attendance at the school minus your EFC or SAI equals your need. So since that EFC and SAI are used to determine your financial need, they make a huge difference in what you'll actually pay for college. So obviously, the lower that SAI or EFC, the greater the need. And some families will already have a low SAI EFC, and many families have the ability to lower that with some proper planning.
And like Scott said, the lower your SAI EFC, the better. And people sometimes realize that maybe they think that there's nothing that can be done about that, but we can lower EFCs dramatically. Whether that makes a difference, that depends on our conversation to find out if that helps you. But also, besides lowering your EFC SAI, the more generous the school you apply to, the better. So the best case scenario is the lowest EFC and the highest generosity school. And every college in America wants you to think that they're the most generous college that ever existed, but this can't be further from the truth. Some schools don't fill your need at all. You can see that on the left. And others will fill it with a lot of expensive loans. And the generous ones will fill your need on the right with a lot of gift aid that doesn't have to be paid back. And that's what we call financial aid, money that you don't have to pay back. So part of our premium software program has a tool that ranks all schools by the historical generosity. And we refer to them as red, yellow, and green based on their generosity. And so when researching colleges, don't just rely on their self-reported claims, their endowment size, or their net price calculators. Those are almost always wrong. You really want to know statistically how generous that school has been for parents with your specific SAI EFC. And this can make a huge difference in what you actually pay despite the sticker price. And in a lot of cases, it can make a private school cost less than even a public school. It's about making sure that you are positioning yourself correctly to get the best deal possible from every college you're applying to, and that includes applying to schools that have more money. So financial positioning and picking the right schools, they go hand in hand like a piece of a puzzle.
Okay, so every family situation is unique. Different types and levels of income, different types of assets, different school lists for the kids, different academic level of their students. So there's no single strategy that works for every family. So depending on your situation, there's going to be different strategies that are going to be more applicable to you than others. So we've kind of divided it into 4 different groups. We've got anywhere from modest income and lower assets. And when we're talking about assets here, we're talking about non-retirement assets. We're not talking about your qualified retirement accounts. And then we have families that have higher income and high assets. Then we have a high income and low assets, and lower income and higher assets. And in general terms, families will tend to fall into one of these 4 groups. And we're going to take a look at an example from each one of these groups showing the specific challenges and opportunities associated with each. So let's start with that lower left corner, that modest income and lower assets. This is going to be the most straightforward scenario. Many times, some of the advanced planning that we talk about is not as critical for these families since they're already going to be qualifying for need-based aid. However, there's still some opportunities and some very important things they need to be aware of. So let's take a look at an example here. So in this case, we've got Christine. She's in California. You can see she's just had one child, 2025 grad. Income 77,000. You can see she's got a little bit of non-retirement assets and a little bit of college savings, but the vast majority of her net worth is in her retirement accounts and her home equity. So let's take a look at the result here. So the first thing I'll say is Christine did a lot of right things in this process. She applied to some generous colleges and she made sure she completed all of her financial aid forms on time and accurately. So if you look at a couple of the sample awards that they received, you can see there was a red college and a yellow college that didn't offer much aid. That wasn't a surprise. We'd already identified those as non-generous schools, but the awards from the two green colleges were really good. And in fact, Christine's daughter ended up going to that green college B, and the net price ended up being lower than the in-state public colleges that she had applied for. And by the time she's graduating, she's going to receive over $250,000 of free money. And sometimes we do see families in the same situation not getting these results, and it usually comes down to one of two issues. One, not applying to generous schools, or making mistakes in the financial aid process. What do I mean by that? Missing requirements, missing deadlines, reporting inaccurate information, including their home equity or retirement accounts with the assets, even though they didn't have to. But the biggest one really many times is that generosity level of the college. It's for families that are qualifying for need-based aid, a school with a cost of attendance of 80,000 that's generous can easily produce a lower net cost than a $50,000 school that's not generous.
So say you're a family on the opposite side of the spectrum with a higher income and significant assets. We're talking non-retirement assets. Often what I hear is that there's nothing that can be done, right, Sam? But most parents fail to realize that there's a lot that can be done. As a matter of fact, this column here represents about 20 to 25% of our clients that have high income above 400, 500, 800,000. I even had a client like the other day, I think it was last week, that had over $2 million of income. And there are lots of ways to save on how you pay for college, and you'll be surprised to know that. Again, you may not be in this exact situation, but the example still applies to you. So if you're a parent in this quadrant, like Paula and Nathan, their income is well over $600,000, and their non-retirement assets are, more substantial. So there won't be any need-based aid for them. But we focus on merit award, and examinations were made on how and when to use their savings to pay for college, including their college fund. And we use one of several tuition recovery plans. We'll talk about that in a minute. As you can see, Paula and Nathan picked up over $138,000 in merit and $120,000 so far recaptured in their tuition recovery plan. So whether you're need eligible, this is super, super important. So whether you're need eligible or you're paying full price, whether your income is $200 or $2 million, the most expensive part of college is not actually the price tag of the college itself. That's expensive. I mean, if you're paying $50 or $80 or $100,000 a year, that's expensive. But what's more expensive is the fact that once that money leaves your account, you have 100% loss of that capital. And you also have 100% loss of its opportunity, or what they call opportunity cost in finance. So you'll never see the money you spent, nor any of its growth potential ever again. And so that's the most expensive part, because otherwise that money that you spent on your child, if you didn't spend it, you didn't have to spend it over 5, 10, 20 years, could be huge comparative to what you spent. So TRPs or tuition recovery plans are ways, and there's many different ones that we use that we customize for the individual families in a way to over time to recover that money that would have been 100% lost otherwise. And over time, a significant portion of that money will come back to you. So if this is something you're interested in, please write down TRP in the corner of your notes and bring it up in your next meeting with us.
Okay, so moving on, we also talked to families with high income but lower assets. Here we see families, 400, 500, 600,000 or more of income, but for whatever reason, just have not been able to save enough for college. And families in this quadrant also frequently think, I'm not going to qualify for aid. There's nothing that can be done, and they lose hope. But similar to our last group, that's often not the case. So in this example, we've got Bob and Jenny. You can see they had twins that graduated in 2025, and Bob's a business owner. So that's going to be a key part of this example. So if you happen to be a business owner or even self-employed, pay really attention to this because there's some good opportunities here. So Bob's in business is throwing off a really nice income, over $450,000. You can see they have, they certainly have some non-retirement assets and college savings, but certainly not enough to pay for 8 years of college education. So the first thing we focused on was the fact that Bob was a business owner, and the fact that he was a business owner, we were able to create tax strategies that are just not available for W-2 employees. And these strategies allow the business owner to pay for a portion of the college bill with tax-deductible dollars and to qualify for federal education credits that W-2 employees with the same income will not be able to qualify for. Now, we also needed to focus on cash flow strategies to reduce the gap and various funding options, including a TRP strategy. So let's take a look at the results. So by the time the twins are done, will have received a total of $144,000 of merit aid, plus the tax savings will be $94,000 by the time we're done. And so far they've recovered $40,000 in their tuition recovery. So about $280,000 saved without one penny of need-based aid. And particularly, when you look at those tax savings, that is just savings that are generated in how the college bill is getting paid for. And some people find that a little hard to believe that those savings could be like that. The truth of the matter is, I've been doing these tax strategies with families for over 20 years. Depending on the tax bracket the family's in, I've seen bigger numbers than that. It can happen all the time. The higher the tax bracket you're in, the more advantageous and successful the strategies are.
Guys, we're running a little bit behind, so we're going to try to cram as fast as we can. There's a lot more detail coming up in a minute, and we're going to try to save a couple minutes in the end for some questions. So what happens if you have modest income but significant assets? Maybe you have less than 100, less than 200, less than even 250, 275, but have 500 million, $10 million in assets. Well, if you're a family in this situation, you might have the most potential to benefit from advanced college funding planning. And there's a lot of confusion here from parents, their tax people, their financial people, thinking that just because you have lower income, that automatically means a lot of aid. In these cases, though, it's not how much you have in assets, but where those assets are and when and how you use them. That's what makes the biggest difference. We'll walk you through that. Obviously, generous schools and properly filling out the paperwork is important here. So this one's interesting. Anil is semi-retired and Priya is a therapist with their part-time jobs, and they have moderate income, and they've done a good job though saving over the years and also inherited some money. So these funds would certainly have gone and cost loss of scholarships, grants, and aid. So we took a critical look at repositioning assets and what those options look like to legally and ethically help them to be assessed as favorably as possible within the rules. The goal here was to balance out their need to afford both college and retirement. And of course, for a family like this, It's also important to focus on that generosity. So what happened? So as you can see here, we picked up $58,000 worth of need-based aid over each year, over 8 years, plus $55,000 so far recovered in their TRP. So we saved over $500,000 for this family. And this is not unusual, by the way.
All right, so we're going to switch gears now and talk about some of the different ways to pay for college. Many parents say that their plan is they're going to use cash flow, meaning they're going to pay for college from their monthly income, monthly cash flow. Now, the thing is, given the high cost of college today, most families are not going to be able to pay 100% of the college costs from cash flow. Now, paying as much as possible through cash flow is very important. Paying from cash flow is the best way because you're not liquidating an asset or taking on financing costs. And so finding hidden cash flow is a big part of the process we go through with families. And many are shocked by how much hidden cash flow we do find in the process. But one important thing to keep in mind when it comes to future cash flow, it's usually contingent upon your job and your health. So therefore, it's never 100% guaranteed. The other thing when it comes to the costs and the cash flow, a lot of times people will tell us, well, there's a hard and fast cutoff for getting aid. I've heard it from all these different sources, but as we talked earlier, there are multiple different ways to get free money from colleges. So if we're talking about academic or athletic merit aid, there's no hard cutoffs. Now, for need-based aid, yeah, there certainly is a point where the family income will be too high to qualify. However, since there are other factors involved, assets, number of family members, age of the family members, how many are in college at the same time, the cutoff point is not going to be the same for every family. And because of the high cost of college, that cutoff point is often higher than families think. And the other thing that happens, there can be things that are artificially inflating their income that can be fixed, or they have income that fluctuates from year to year, or have an unusual one-time income hit in a certain year. And there are strategies to help with all of these issues. Now, sometimes we see on the other side of the fence too, families with lower income who assume they're going to automatically receive aid because of that lower income, but because there's other factors involved, that's not always the case. And Sam's going to walk us through a recent example that he experienced.
So this family's out of the Midwest, had two daughters, a couple years apart. They decided to go visit all their schools, about 7 schools, and each of the times they went to visit the schools, they went to the financial aid office, shared their tax returns and other things with them. And every one of those schools said that there's going to be a ton of financial aid for them. Their income was only about 130, 140 a year. So Yale was one of those schools, by the way, and sometimes you can find this on their websites, different schools. You can see here on the left, annual income range of 100 to 150. They're right there. The average scholarship was $63,000. Well, this family ended up only getting $19,000 from Yale. What happened? Well, because they failed to read the fine print. The Yale calculates expected family contribution through a holistic review process, includes parent assets and student assets. They did have money that hurt them on 529s and other accounts, and so they ended up not getting as much. So this is a very, very important thing to look at. Be diligent, read the fine print, and always properly prepare ahead of time.
So as you can kind of figure out by now, income does play a major part in that SAI EFC calculation. And it's really calculated, the whole SAI EFC is similar to a tax calculation where the lower dollars are assessed at lower rates. And then as you move up through the table, the assessment rate goes high. The top assessment rate is 47%. And again, when most people think of income, all they think about is that their wages, their earned income. But the income, as Sam had mentioned before, can include things like add backs for retirement contributions, interest, dividend, capital gains, rental income. And really part of the college funding planning process is to manage the impact of these different sources of income on your tax return. And most people, even financial professionals for that matter, just don't understand how all that comes together.
All right, so let's talk about assets. Most most parents will use some of their assets to pay for college, and it could be the 529 college savings account or UTMA, UGMA account, CDs, money markets, investments, bank accounts, real estate. I've seen it all. Okay, but without proper planning, liquidating these assets may cause a taxable event, penalties. It can reduce your principal, and then that money isn't working for you anymore. Back to that opportunity cost we talked about earlier. It can hike up your EFC SAI. We see that all the time. So it may not even count against you where it's at, but now you've taken it out of its shell and now it counts against you. So be careful when you're doing that. Don't just think of it like I'm just going to do a transaction, but what are the consequences of that? Something else I want to add real quick that I get sometimes is how do the schools know that I have this money? Well, there's something called a DRT. It's been around since 2010. They've made it much more intrusive. So they're able to kind of share information with the IRS with your information and be able to tell what's going on.
Okay, so when it comes to assets, not all assets are treated the same. Depending on the asset type and the methodology used by the college, the assessed assets will be assessed at a rate of anywhere between 5 to 25%, meaning 5 to 25% of the value of that asset gets added to the SAI or the EFC each year. And the student assets have the highest assessment rate. So the 25%, that's associated with student assets. So if you think about it, just having $100,000 in the wrong type of account could cost a family $5,000 to $25,000 each year for 4 years of college. So obviously, if it's being assessed at 25% each year for 4 years, that asset basically has no value by the time it's over. And based on our research, we think the average family can reduce that EFC SAI by around $24,000 a year with making some adjustments.
And Scott, can I jump in there real quick?
Yeah, jump in.
Let's say you had zero income. Zero. So on the income assessment was zero, but on the assets you had $200,000 sitting in non-retirement assets. Well, that 200,000 might have a 5 or 6% assessment at the lowest calculation. That might be $10,000 or $11,000 of assessment. So you might be thinking, well, I'm applying to a school that costs $91,000. They think I could afford 11, right? Based on that asset. So I'm 80 is up for grabs, right? Technically, yes, but that's not how the real world really works. What happens is the colleges are saying, why don't you spend your money first and then we'll spend ours. So what Scott was saying, this is the minimum calculation. But a lot of times people don't factor in that we've seen people lose out on tons of financial aid, way more, just like the Yale example, just because they had a couple 300,000 or whatever laying around in various accounts. So be very, very diligent.
Yep. Okay. And then the other thing that can happen with assets is some assets have a compounding impact because they're creating income on your tax return. So now you're going to get assessed for the value of the asset itself and the income it's generating. This could be interest income, dividend income, capital gains, rental income. And this can be really damaging because, as we just talked about, for many families, the top dollars of income are being assessed at 47%. All right, so then moving on in the ways to pay for college. Now the third way is loans, and again we get nobody's excited about loans, but for many families, some financing is a part of a college funding plan. In some cases it's required to fill a gap, and in others it's a choice to finance some of the costs rather than depleting an asset due to tax consequences or opportunity costs associated with that asset, or even to utilize the TRP strategy that we've talked about. Now, once again, there's a lot of details about loans in the workshop companion guide, so we don't have time to cover it all here. But one really important thing that you need to be aware of is as of July 1st this year, there are new lower federal loan limits on federal loans. Now, the biggest impact of these lower loan limits happens at the graduate level, but even at the undergraduate level, the Parent Plus loan, the federal loan to the parent for undergraduate studies, now has a new loan limit of $20,000 per year, but a lifetime max per student of $65,000. And so basically what's happening with these new loan limits, it's for many, many families, it's not going to be possible to finance 100% of college through federal loans like it used to be. The other thing when it just real quickly, when it comes to loans, everyone thinks naturally of the traditional college loans, federal loans in the parent's name, federal loans in the student's name, private student loans. But you don't have to use those loans. You can finance college any way you want. So what you want to do is find the very best borrowing strategy, regardless of where that money is coming from. And, you know, because anytime you're borrowing money, that interest becomes part of the overall college cost, and it can have a huge impact on the overall college cost. And Sam's going to walk us through an example on that right now.
Yep, exactly. Imagine if you can borrow sub 4%, sub 3% in some cases, right? How much that would make, what kind of thoughts you would have on how you would finance college. So here's a hypothetical of how a traditional college loan can differ greatly from another loan, right? So say you're going to borrow $200,000 for one child to go to college. Call it $50,000 a year. I know some schools cost a little bit less, some schools cost twice as much, but let's just go with it, right? And so if you went with a traditional loan, your terms, interest, fees, you can expect your interest rate to be somewhere between 6 to 12%, or even much, much higher than that. So you're looking at family A doing that. Maybe a payment could be $2,000 or $3,000 a month, give or take. It could be 14, 15, 20 or more years before it is paid off. But let's say family B made some adjustments and now was able to get that same amount of money, but this time their payment dropped by half or a third or whatever. But not only that, their term ended up being a lot shorter as well. So the difference over time on just how you pay for college could save you 50 or even $150,000 in this example. So keep in mind that there's lots of ways to pay for college, and most people don't even scratch the surface on these options. Another thing I want you to think about, and based on our research with working with literally tens of thousands of families, is 78% of our families, our parents will go through at least one life-changing event during the college process. It could be a marital change, it could be a loss of a partner, having more children. As a matter of fact, that happened this week where a client of mine had about, I think it was 10 or 11 years between the youngest and now the youngest. Job changes, we see that a lot these days. Sale of business, inheritance, retirement, those kinds of sudden financial changes. The question that you need to ask is my game plan to pay for college around if only if things go perfectly, we're fine, or what happens if things go wrong? What's plan B and plan C? So we're always looking at those options. And so all the scholarships, grants, and aid in the world won't mean a single thing unless your kid gets in. Now, we do see families that pay a lot of money to have someone help them. I don't think you need that. I think there's a lot of tools out there on the admission side that can help you. You can work with your guidance counselor, or maybe this is something that maybe on the internet or AI could help potentially. But if you're really looking for personal one-on-one admissions coaching and you just want someone to help, we do have some low-cost options. Let us know. It's not a huge feature that we want to push, but if you need it, there are more affordable ways that we can handle that.
All right, so as we've talked about, every family situation is unique, and maybe every strategy that's out there is not going to apply to every family. So one of the first steps in the planning process is to figure out which strategies are going to be most beneficial to you. In a minute here, we're kind of getting close to the end. Sam's going to talk about how you can take advantage of a free college assessment, and that's part of what we can do is walk you through where your opportunities and challenges are going to be. For some families, they have the ability, qualifying for more grants, aid, and scholarship. The whole athletic is a whole nother part of the process. Doing the TRP strategies we talked about, tax savings for some families. If having the most effective borrowing strategy, if borrowing is going to be needed. Some or all of those could be applicable to you, and that assessment is the first place to get started with that knowledge.
And as Scott said, this is no cost or obligation for you. This is where you ask your questions. I'm dealing with this. This is my situation. Is there anything that we can do? What should I be looking at? All those questions in that call. So to set up your SmartTrack account only takes a couple minutes. The link's in the chat. Fill out your assessment. Takes another maybe 5 to 10 minutes max. We don't ask for anything sensitive. We don't ask for social security numbers, account numbers. Just tell us what state you live in, what year high school graduation. Do you have a 529? Do you have non-retirement assets? Do you own rental properties? Do you own a business or your W-2? Those kinds of things. Very, very simple stuff. And then get your evaluation or book your free appointment, right? It's 15, 20 minutes. We're on the call. It's not a sales call. The last thing we want is to work with somebody we can't help. And most of the people that get on the call, we can't help, but we would rather have you understand how we can help you and what that procedure looks like. And then you can decide from there. So that's really, really important. And you're not talking to a call center. You're talking to like the least experienced person on our team has 10 years of experience. So really talking to an expert. So write your questions down and bring it up to the meeting. And we do have a few questions, speaking of questions, that we're going to try to go through really, really quick. All right, so how much does it cost if you decide to go with us? First of all, we have some software. Software is a one-time, not per year, not per student. It's a one-time. You can use it for multiple kids. It's called SmartTrack Premium. It's normally $445. You get it for $347, so you get a small discount for your Champion Elite members here. You can see how generous the school is going to be before you apply to it. You can also fill out the paperwork. It'll save you a lot of time and stress, but most importantly, it'll save you the errors. And errors is what cause you to lose out on money. So the software help you do those things. And then we have Advisor. SmartTrack Advisor is working with a special advisor, like a college funding advisor that's on our team, specifically in how to pay for college, how to save money and how you pay for college, how to save money on your taxes, like Scott said, how to save money on your EFC SAI by qualifying for more aid, grants, and scholarships. It really depends where you sit in those 4 quadrants, right? And so this is a one-time investment. We don't charge per year. We don't charge per student. We don't charge per meeting. It's one time, and it's only $597. And normally we have somewhere between 3 and 8 meetings. So that's all included, all inclusive of that. And the most popular option is just to get the bundle. Let's not decide on that yet, because sometimes I tell people don't get the premium software, just get the advisor. So, but if you wanted the whole shebang, it's $797 all in. There's no surprises. There's no, I forgot to tell you this and that. It's all we ask is if we do a good job, you let somebody else know about us. Is that fair? And if that weren't enough, we're so confident that we can save our families tens of thousands of dollars legitimately, that if we can't save you at least $10,000 off college expenses and save you money on how you would have paid for college, we'll give you that advisor feedback. It's that simple. Okay. That's how confident we are that we can save you so much more than $10,000. All right, real quick. So create your account using the link in the chat and the email address you use to register for this workshop. Make sure you use the link, okay, so that you don't have a duplicate, then we have some issues here. And our system only accommodates one parent account, so there's no need to make one for each of you, just one. Give us that information. And if you already set it up, that's great, okay? And then the 5-minute assessment, like I said, 5 to 10 minutes max. Just go through it. It's very, very easy to do. And then we'll see you there on the next steps. I think we already got that, right? So we go to questions here, Scott.
Yep. Yeah, let's do it.
All right.
I have start.
Should I take like 2 or 3? Or you want to take the first one? I'll take the next 2 or 3.
All right, I'll take the first one. So I got one here. Parents wondering if applying early decision or early action is going to have impact on their financial aid award. So early decision is a binding application you're submitting to the college. You can only apply early decision to one school, and if you're accepted, you're supposed to pull all of your other applications. Because of that, there is statistical proof that your chances of getting accepted go up, but there's also a good chance you're going to pay more. They have less incentive to maximize your financial aid award because they know they kind of got you. So you got to be really, really careful with early decision. Now, early action that you're still applying earlier deadlines. You're going to find out earlier whether your student's been accepted or not. But you still have until the May 1st deadline to tell the college where you're coming or not. So you don't give up any leverage in the process. By applying early action, you are demonstrating high interest to that college, letting them know you're interested. So we're big fans of early action, but pretty cautious when it comes to early decision.
I'm gonna go like a shotgun here real quick, Scott.
Yeah,
So,
go.
one is I make too much money. What does that mean? I mean, everybody wants to save money. Even if you make $1 million a year, if you can save 100 or $200,000 or more, I think you love us forever. So, a lot of our clients, about 30% of our clients, make more than $500,000 a year. I have a 2029. Is that too early? No, because like Scott was saying, your base year is going to start next year, 2027, January 1st. So you want to 2020 30s and 29s, perfect time. As a matter of fact, my youngest client is not even born yet. It's going to be born next week. She's like literally the parents are, she's pregnant. And so that's my youngest client. I've never had a client that young. So
I've never had one that young either.
2029s and 30s, perfect timing because your base year is not started yet. If you're 2028, you're in a 911 position because literally your year is going to be ending in just a few more months. And then you have the 2027s, your last minute. You definitely want to get on the calendar as soon as possible because there's a last minute adjustments. Should we stop funding our 529? We're not saying that. Don't take anything we're saying on this presentation as gospel as far as making changes to your financials. But all we're saying is 529s and other non-retirement accounts are heavily assessed against you. I think that's.
I got one quick one here.
Yes, go ahead.
I just lost my job. How does that impact things? So because of that 2-year gap between the income they collect and when your student starts college, there's a process called a special circumstance appeal. So anytime your situation changes, so the financial aid forms you filed don't adequately represent your current situation, you can file a special circumstance appeal, and many times will be successful in getting them to reanalyze your numbers based on your current situation.
Absolutely. And I would say 99% of the time, people that do that, they do it the wrong way. And there's a procedure and a way to do that to maximize, or you end up blowing your only other shot at this. So if that's your case, please let us know. Like I said, it's a free meeting. Everybody should take the free meeting. It's not a sales call. Bring your questions. We'll bring our answers. I think we're done.
All right.
Thank you guys. Thanks for taking the time and working with us tonight. And I look forward to speaking with you guys in our calls. You're going to get a recording of this. So if you have a spouse that needs to listen to it, feel free to share with anybody else, a friend, a neighbor, coworker, and we'll go from there. Thank you so much. Take care, guys.
Thanks, everyone.
Bye-bye.